Welcome to Your Money with Leo Daprile. I'm Leo Daprile, and each week on AM 570, Dan Rivers and I will talk about anything and everything to do with your money. If you ever have questions, please feel free to call me at 330-533-6936, or you can email me at leo@gemyoung.com. Enjoy the show.
This episode of Your Money with Leo Daprile is sponsored by Grange Insurance.
Time now for Your Money, and we're brought to you by Gem Young. Gem Young Wealth Advisors, a family business that does business with individuals and families that need comprehensive risk management for their wealth and assets. And they believe the clients want professional advice at a fair value, and they deliver that by leveraging their reputation of professional integrity and teamwork to get it done right the first time. Leo Daprile is with us, and Leo, how you been?
I'm good, Dan. Good morning to you.
Nice to have you along here this morning. We're going to start by talking about Ronald Reagan's days, and they were talking about Ronald Reagan when he was in the White House. We saw an astonishing growth in our economy. What was that number, Leo?
It was in the 20s. I think it was a 26% number, Dan. It was huge.
Annualized,
and we're getting ready to go
time.
down that track again is what everybody's predicting. In fact, this morning I was doing some research, and this week really kicks off earnings season for the quarter, and although we've had a very strong run up in stocks, I'm looking at a couple of things here. I'm looking at when earnings come out, number one, are people meeting the earnings, but that's only part of the story, I think, that I'm going to pay attention to over the next couple of weeks. I'm really going to pay attention to what the forecasts are going to be for the rest of the year. We spoke a couple of weeks ago that getting to a good year might be bumpy, and this next couple of weeks may be just that, because we've had a strong run-up and since mid-March in all sectors of the market. It wasn't that long ago, Dan, that we were talking that all the indexes for the year were negative absent the Dow Jones Industrial Average. Well, since then, everything's turned positive, and we've had quite a run-up that we're averaging between a 7 and a 10% return for most of the averages for the year. That's a big turnaround to have happened. And so we have to see if the earnings that are going to come out are going to justify this substantial of a run-up so quickly.
So if you can't raise the interest rates, what other tools do you have to slow the economy a little bit?
I think there's two things going on. And on 60 Minutes on Sunday night, they had Jay Powell on, the chairman of the Fed. And he really made a statement, Dan, that resonated with me, and it was kind of an aha moment for me when he talked about inflation. We typically think of inflation in terms of the United States, and we worry about inflation running too hot and then the Fed having the tool to raise the interest rate. Well, he talked about international inflation as one of the reasons why our inflation rate over the last decade has remained so low. Because the point he made was when things start to get to be too expensive to manufacture over here, our traditional thinking would be, okay, that's inflation. But his point was, well, having an international economy, if things start to become too expensive to manufacture here, companies have the option of taking that manufacturing overseas where they can then produce those goods cheaper. And that's what's been holding the inflation number in the United States down. And he sees that happening going forward, maybe more so than what we're seeing right now.
Let me feed that back to you. Are you saying that Powell is advocating that this is a good thing, that if we have the ability to move production to a low-cost center, that that's going to keep inflation down?
He didn't necessarily say it was a good thing. It was more of an observation of this is why inflation seems to be so low and why he thinks inflation's going to be low. So he thinks for us to get to the 2, maybe as much as a 2.5% inflation rate, because of the international manufacturing that we have, we can moderate the length of time before we get to what we would traditionally consider too much inflation or runaway inflation. There's other throttles to help keep that in check. Because of that, Dan, they're taking the position that because of that, there's no reason that they don't really see raising interest rates into 2022, and some of the Fed governors are saying maybe not until 2023, even with these big growth numbers that everybody's projecting right now.
So just for the novice out there, if in fact you allow the economy to continue to be heated up, prices rise to the point and you're kind of penalized by those higher prices right now. Do those higher prices help the consumer at all? Does it raise wages?
Only if all boats rise. If we have an increase in pricing, but we don't have an increase in wages, then no, that's actually a detriment back to the consumer because there becomes the disparity. But one of the things they're talking about, Dan, they said at the end of the year that they thought unemployment by the end of 2021, the average number said we would get down to a 5.6% unemployment rate. Those economists that came up with that number revised that estimate down to a 4.8% unemployment by year end. The interesting conundrum that we have is so many people now with the extra stimulus checks, a lot of workers are needed now that aren't taking the jobs because it's beneficial for them to stay home. So I think there is going to be a short-term drag in the drop in unemployment because of the amount of federal stimulus we have in the system, where it's creating a disincentive for people to go back to work.
You know, the funny thing about it, too, Leo, the same people that are always unemployed are the people that are always unemployed. And even when you have the jobs out here, I just got a letter from someone that said they're in the Carolinas, they can't find restaurant workers. I'm sure that it's about the same here. But, you know, when we talk about the chronic unemployment, we're going to have people that are just simply not going to be able to do these jobs simply because they don't have the communication skills or they're untrainable. And I think that workforce is a real problem out there. And even if you raise prices, there's only a finite amount of people out there that can do some of the jobs. And I'm talking about, you know, if you're interacting with the public expects a certain level of expertise, whether you're selling a car or you're delivering food to a table.
I can give you two examples on that, Dan. I was speaking with a client yesterday that's in the landscape industry, was looking to hire an individual, found the candidate that had the skill sets that they needed, wanted to hire them, and the person came back to them and said, well, between my federal stimulus and between my unemployment, I'm making $17.60 plus cents an hour. I don't remember the exact number. It was $17.60 and some change. If you can match that or beat that, I'll come to work for you. But anything less than that, I'm staying at home.
Mm-hmm. It's terrible. So, that is a terrible. And we've cooked that in for the next 6 or 7 months, haven't we? We have. So it's funny that we thought unemployment. Everybody's talking about unemployment, and with this federal stimulus, that's actually, even though there's more money in the economy, to your point, Dan, having skilled people in these jobs, a lot of them are just going to enjoy their time because they have the money to enjoy their time. So unbelievable. Even
though everybody's expecting this robust growth, this can actually become a hindrance to it.
Well, you know, here you got this $1.9 trillion that they want to put out there for infrastructure investment. I was pushing yesterday to figure out what they were going to do with the money. It's not roads and bridges. And then Biden said we can't invest in old technology. But I'm thinking to myself, if you're building roads and bridges, that's going to be pretty much needed for the future. I can't believe that they're going to put out this infrastructure plan and so little of it is going toward brick and mortar.
Yeah, I was surprised at that too, Dan. And funny you bring that up because I was drawing the same conclusion. Because just like in the COVID-19 bill that they passed, so much of it wasn't COVID-19, but it was so many other things in there, which you so accurately reported in your prior shows. And you're going down the same road with this, that what they define as infrastructure is a completely different definition than what we think infrastructure is. And no matter what goes on, people still need to move. And they've been saying for decades that we have crumbling bridges and roads. So focus on fixing that, but putting I don't know how many billions into broadband. I think that's a state and local issue, and that shouldn't be the federal government controlling the communication of the world.
Well, absolutely. And then you also have the issues out here where, you know, they're saying we're going to use new technology and put in these charging stations. I still say that I'm right on this, that these charging stations will be built when they're demanded. Not somebody anticipating where we're going to need these. I mean, you can have some of that, but you know what? You can look at the Shells and the Sheets of the world. They're going to be in on this. If they think charging stations can be something that they get their money back on, they're going to build them.
I am in resounding agreement with that. Let capitalism work and don't supersede capitalism. To your point, if you build it correctly and if you build it profitably, and if there's that many electric cars on the road, they're going to have to charge somewhere, and there's plenty of opportunity for growth there. So I don't think the federal government needs to start building these. I'm totally in agreement with that.
I've got a lumber story I want to share with you, but first of all, if you'll be so kind to tell our audience what you do, and I've sat in on your sessions, and you do a very effective job. Tell the people about your line of work.
Well, in our insurance and our wealth management businesses, we start by having a fit meeting with our clients. We find out exactly what your goals are, your objectives. We make sure that we're a fit for each other. From there, we build out a financial plan that's suited for you, built specifically for you. As you know, Dan, we start with what we've put together over years, a sheet called What's Important to You, where we're able to help folks define and do some personal goal planning, because most people don't ever do it. In fact, I had a conversation with a prospective client yesterday. He says, when people come to see us, they have a lot of financial concerns, and every one of those is a one in their mind. And that's what causes a lot of financial stress and anxiety. So what we do is we help prioritize those to what matters most to them, so that they can get their arms around what they really care about, and then we build a plan accordingly. It's a pretty exciting process.
It really is, and my wife and I have sat down with Leo, and one of the things is that you find out things about yourself that you didn't know, because you're wondering what you want to do when you get older. Leo will help find that, and they do that very effectively. You can call them at 533-6936. Leo, what's the email?
Or you can email me at leo@jemyoung.com.
Or call 330-533-6936 and set up a fit meeting with Leo Daprile. Just one more thing I want to run by you here. Over the last year, lumber prices have gone up 500%, and they say that that's comparable to the price of gasoline going up to $13 a gallon. There's inflation,
crazy.
Huh? Yeah. Yeah.
Dan,
that's crazy,
I talked to another client yesterday that's a contractor. And he told me as he's bidding out new homes, he's telling his prospective new homeowners, expect your lumber costs based on the size of the house you're building, your raw material costs to go up between $30,000 and $50,000.
There's a tremendous demand for housing right now. There's no housing available in some cities, and they say that these interest rates are extremely low. That's fueling some of it, but the lumber prices have leveled off, but I don't like where they've leveled off. I mean, when you're thinking about, and we often say 2x4 from $250 to now over $6.
Yeah, that's exactly what's going on. And I asked the question, do you see prices coming down? And I asked my contractor friend yesterday, I said, do you see the prices coming down anytime soon? He goes, not really, because they're selling everything that they're bringing in. So as long as they're selling everything they're bringing in, there's no incentive for them to reduce the prices.
Yeah. Some new mills are expected to open in Canada relatively soon. That should help a little bit with the supply issue. But it seems like that would be rife for the United States to get some of these lumber mills open again and get started. Leo, it's always a pleasure. I appreciate that. Again, give your information if you will.
Sure. You can call me at 330-533-6936, or feel free to email me at leo@jemyoung.com.
All right, he'll help you out. Leo Daprile from Gem Young Wealth Advisors. They can help you out and meet your goals.
Thanks for watching the video. Be sure to like, subscribe, and hit that little bell for notifications. And also make sure to connect with us on Twitter, Facebook, and LinkedIn. For all of your business news, visit businessjournaldaily.com. For all of your arts and entertainment news, go to afterhoursyoungstown.com.